We spend so much time analyzing market cycles, right? Looking at all the on-chain data, trying to figure out if we're in a bull or a bear market.
Of course. It's the standard investor loop.
Yeah, you allocate capital, you wait for it to appreciate, you sell for a profit, and then you have to figure out what to do with the cash.
It's the liquidity trap. You're always looking for the exit,
Mm.
which is, completely rational if you view the asset as just a vehicle to get more fiat currency.
Exactly. You buy one thing to get more of another thing.
Mm-hmm.
But the source we are breaking down today, it's called Financing an Entire Life with Bitcoin Loans. It proposes a complete inversion of that whole logic.
A total flip.
The premise isn't about when to sell. It's an argument that if you really understand the asset, selling is, well, it's a mathematical error. The goal shifts from buy low, sell high to something more like buy, borrow, and never sell.
It's a move from a trader's mindset to a treasury mindset.
Yeah.
And just to be clear for everyone listening, this isn't some generic HODL meme.
Not at all.
The document is a real first principles exploration of using Bitcoin as a perpetual collateral instrument. It's looking at how you finance everything from a mortgage to end-of-life care without ever triggering a taxable event.
Or losing your position size. And the author frames this whole thing specifically around sovereignty. This isn't your typical financial advice. It reads more like an engineering problem.
It is an engineering problem.
Yeah.
How do you design a life where your purchasing power goes up over time while your expenses are covered by debt that, in effect, pays for itself?
That's the core thesis, isn't it?
That's it. It all relies on the spread between the cost of capital, the interest rates, and the appreciation rate of the collateral of the Bitcoin.
So if Bitcoin's growth rate stays above the cost of borrowing, the loan is essentially subsidized by the asset's own performance.
Exactly.
Okay, let's dig into that buy, borrow, die mechanic, because we know the ultra-wealthy already do this. Larry Ellison isn't selling Oracle stock to buy an island in Hawaii.
No, he's borrowing against it. But that usually requires a private banker, a massive balance sheet, all sorts of relationships.
Right. So the source is arguing that Bitcoin actually democratizes this.
It compresses the strategy. That's the key phrase.
Compresses it.
Yeah, in the legacy system, you need all those relationships. You need illiquid assets like real estate or restricted stock. Bitcoin just changes the collateral profile completely.
Because it's liquid 24/7, it's global.
Pristine collateral, no counterparty risk, instantaneous settlement. The source argues that because of this, an individual can run this whole strategy from a laptop.
Okay, but let's look at the math the source presents. Because borrowing, to most people, feels like adding risk. We all try to get out of debt.
Right.
So why is this document arguing that taking on debt is actually safer than selling the asset?
It comes down to what the source calls the one-way door concept.
A one-way door.
Selling is irreversible. When you sell Bitcoin to pay for, say, a roof repair or a car, you are permanently exchanging a hard, finite asset for a soft, inflationary currency.
And you trigger capital gains tax.
Instantly. So you immediately lose, 20 to 30% of your purchasing power right off the top?
That's the tax drag. So if I need $10,000, I might have to liquidate $13,000 or $14,000 worth of assets just to cover the tax bill and the cost itself.
Precisely. Whereas with a loan, you don't trigger that tax event.
Mm.
But the bigger issue the source highlights is the opportunity cost.
What you're giving up.
What you're giving up forever.
Mm-hmm.
If Bitcoin continues to compound at, let's say, a generic 15 or 20% a year,
Mm-hmm.
which is conservative compared to its history selling early, means you miss out on all that compounding. Forever. You killed the goose to get the egg.
Okay, the counter argument, though, has to be that debt carries interest. You have to service that loan. If I borrow at 8%, isn't that just eating into my wealth as much as a tax hit would?
Over a short time frame, maybe. But the source models this out over decades. If the asset appreciates at 15% and your debt costs 8%, your net equity is still growing.
You're in a positive carry situation.
You're in positive carry. The debt is fixed in nominal fiat terms. That dollar amount doesn't change, but the Bitcoin value backing it just keeps expanding.
So you're basically shorting the dollar and longing the collateral.
Effectively, yes. You are betting that the denominator, the fiat currency, is going to debase faster than the interest rate you're paying.
This brings us to the part of the deep dive that I found the most compelling and honestly a little dark.
The aging part.
The aging part. The source pivots from the mechanics of wealth to the reality of getting old. It tackles what it calls the decumulation problem.
And this is where the engineering mindset meets, biological reality.
Right.
The traditional retirement model is Save up a pile of money and hope you die before it runs out.
That's decumulation. You're just eating your own capital.
Exactly. And the anxiety there is, it's huge. The source talks about the cost of nursing homes, medical care, all the things that usually wipe out a middle-class family's entire inheritance.
It's the tragedy of the current system, really. You spend 40 years building up equity in a home or a portfolio, and then in the last 5 years of your life, you liquidate everything to pay for care.
And the family wealth just resets to zero for the next generation. The source proposes that if you use this borrow strategy, you never decumulate. You draw liquidity from the Bitcoin to pay the nursing home, but the Bitcoin itself stays in the vault.
How does the loan get repaid, practically? If I'm 85, living in a care facility, borrowing against my stack to pay the monthly bill, that debt is just piling up. I'm not working to pay it off.
You don't pay it off.
You don't.
You roll it.
Explain what that means.
As long as the LTV, the loan-to-value ratio, remains healthy, you can refinance the interest back into the principal. Or you take out new, small loans to pay the old interest. If the asset doubles in value every 4 years and your debt only grows by, say, 6 to 8% a year,
your LTV actually drops over time.
It drops over time, even if you never make a single payment out of pocket.
See, that's the magic math that makes people so skeptical. It feels too good to be true because it assumes the asset always goes up.
It assumes the asset goes up over long term relative to the debasement of the currency. And then eventually, when the owner passes away, the estate settles the debt. They sell just enough Bitcoin to wipe the loan clean.
And the remaining collateral, which hopefully has appreciated significantly, goes to the heirs.
That's the plan.
So it solves that liquidity versus legacy dilemma. You don't have to choose between having cash to live on now and leaving money for later.
That is the promise. But we have to be very, very careful here. The source is not selling a free lunch. This strategy introduces risks that simply don't exist if you just hold cash in a bank.
Let's get into the mechanics of that, because the source gets pretty futuristic here. We are not talking about walking into JP Morgan and asking for a loan against a hardware wallet.
Not even close. The document focuses heavily on smart contracts and this idea of programmable finance.
This is the shift from trust to verification, right?
It's exactly. In the world today, if you want a loan against assets, you need a credit score, income verification, a human underwriter who has to approve it. The source envisions protocols where the collateral is the credit score.
You just lock the Bitcoin in a multi-sig vault or a smart contract, and a stablecoin is minted directly to your wallet, no questions asked.
And the source highlights some really specific features that make this viable for that end-of-life scenario. For instance, automated liquidation protection.
So if the price drops,
the system can automatically sell a tiny sliver of collateral to pay down the loan and keep the rest safe. You don't have to wake up at 3 in the morning to wire funds to an exchange.
Or the dead man switch.
Right. This is huge. This addresses the inheritance issue. If you are your own bank and you die, your keys could die with you.
Huge problem.
So the source describes using time-locked contracts. If the owner doesn't ping the network or sign a transaction for, say, 12 months, the smart contract automatically reassigns ownership of a collateral to a pre-designated heir's wallet.
That is wild. It completely bypasses probate, bypasses lawyers. It's code-enforced will execution.
It's incredibly efficient, but it's also terrifying if you mess up the setup. If you set the timer wrong or if the heir's wallet is lost, that money is just gone. There is no customer support line for a blockchain.
And that leads us directly into the risks section of the paper, because while the upside is this idea of generational sovereignty, the downside is total ruin.
Complete ruin. The source is incredibly explicit about the dangers of volatility.
Volatility is the absolute killer of any leverage strategy.
It is. If you just hold Bitcoin, a 70% drawdown hurts your feelings. If you have a loan against it, a 70% drawdown can wipe you out completely.
We really need to put some numbers on this, because people hear borrow against your assets and they immediately think they can take out 50 or 80% of the value.
The source calls that suicide. Absolute suicide. If you take a loan at 50% LTV, so I'm borrowing $50,000 against $100,000 of Bitcoin, and the price drops by just 33%.
You're getting margin called.
You're getting margin called. And in Bitcoin, a 33% drop is a Tuesday.
So what does the source consider a safe ratio then?
Extremely conservative. We're talking single-digit or maybe low double-digit LTVs, 10 or 15%.
Okay, so if you have $1 million in Bitcoin, you only borrow $100,000.
Right. That way, Bitcoin would have to drop 85 or 90% before your collateral is even at risk of liquidation.
which brings up a pretty significant barrier to entry. To live off a 10% LTV loan, you need a massive stack to begin with. If you need $50,000 a year to live, you need $500,000 in Bitcoin just to get started.
And that's the reality check. This is not a strategy for someone trying to get rich. It's a strategy for someone who is already wealthy in Bitcoin terms and wants to stay that way.
It's capital preservation, not capital creation.
The source calls it slow thinking.
There's also the issue of counterparty risk, which the text mentions. Even with smart contracts, someone or something is holding the keys to that locked Bitcoin.
And that is the friction point today. If you use a centralized lender, we all saw what happened with Celsius and BlockFi, you might wake up one day and find your collateral's just gone because the lender gambled it away.
And if you use a DeFi protocol, you risk a smart contract hack or a bug in the code.
So the source suggests things like collaborative custody or multi-sig setups.
A 2 of 3 setup.
Yes. The gold standard mentioned is a 2 of 3 multi-signature arrangement. You hold one key, the lender holds one key, and a neutral third-party arbitrator holds the third.
So the lender can't move your funds without you, and you can't run away with the funds without paying back the loan. It mathematically enforces the contract.
It prevents the rug pull.
Minimizes it, at least.
Right. Nothing is zero risk, but it removes the risk of the lender simply stealing the funds.
I want to push back on one more thing here. The source kind of implies that the fiat system will continue to function well enough for you to spend these borrowed dollars. But if Bitcoin is monetizing because the fiat system is collapsing, are those dollars we're borrowing even going to buy anything?
That's the hyperinflation edge case.
No.
And it's a valid one. If the dollar completely collapses, the loan effectively becomes worthless, which is great for you, the borrower, but the lender might not even exist anymore.
Right.
But the source really operates in the muddle-through scenario. The assumption isn't the apocalypse. It's just persistent, high inflation, 5 to 10% monetary debasement year after year.
So in that world, the debt is just inflated away and the asset retains its purchasing power.
You're betting on the Argentinian model of the future rather than the Mad Max model.
That is a great way to put it. You want to hold the hard asset and owe the soft liability.
Always.
Okay, let's zoom out. We've talked about the math, the smart contracts, the risks. But what's the philosophical shift here? The source concludes with some really open-ended questions that have been kind of haunting me.
The one that stuck with me was, what breaks first, the fiat system or old age planning?
It suggests our entire current model of retirement, the 401k, the pension, is mathematically broken.
It suggests that savings simply cannot outpace debasement. If you're saving in dollars, you're on a treadmill that's constantly speeding up. This buy, borrow, die model is an attempt to step off that treadmill entirely.
It's an attempt to treat your wealth as a permanent endowment rather than a shrinking checking account.
Yeah, and it changes the definition of rich. Rich isn't having a high income anymore. Rich is having a low LTV.
Rich is having unencumbered assets that work for you.
And the really profound shift here is emotional. The source talks about dignity. If you don't have to ask your children for money, if you don't have to sell the family home, you retain agency over your own life, right until the very end.
But only if you have the discipline not to get liquidated.
Discipline is the price of sovereignty.
So here's the challenge for you, the listener. We are not telling you to go take out a loan tomorrow. As we said, the infrastructure is still raw, it's still being built. But look at your own financial plan for the next 30 years.
Ask yourself,
Yeah.
is it based on selling your assets to survive?
Or is it based on owning assets that support you?
And if you believe we're entering an era of persistent inflation, holding on to the scarcity might be far more important than the temporary liquidity of a sale.
What does a 30-year Bitcoin loan actually look like? We don't know yet, but the source suggests we better figure it out. Because the alternative selling perfectly good property for paper money might be the biggest financial mistake of our lives.
It's definitely a one-way door you don't want to walk through lightly.
We'll leave you to chew on that. Thanks for diving deep with us.